Welcome to Sinomania. Fundamental misalignment. The U.S. Congress declares currency war on China. Chinese markets rebound, and for you fearless daredevils, more Chinese IPOs. Major volley in the China blame game was lobbed this week in the U.S. Senate with the introduction of the so-called Fair Currency Act of 2007. The legislation is a bipartisan effort of senators ranging from Max Baucus of Montana to Lindsey Graham of South Carolina, and is the latest attempt to legislate an appreciation of China's currency, now desired at 40%. The bill is cleverly crafted to disguise trade protectionism as exchange rate impact on select American imports by determining whether China's currency is in fundamental misalignment. Such determination would then lead to a WTO decision on slapping import tariffs on the Chinese goods in question. On the surface, this process is anti-free trade and in its definition fantastically subjective. For example, fundamental misalignment is described as, and I quote, a material sustained disparity between the observed levels of an effective exchange rate for a currency and the corresponding levels of an effective exchange rate for that currency that would be consistent with fundamental macroeconomic conditions based on a generally accepted economic rationale. This implies that Congress will be well versed in the fundamental macroeconomic conditions of a country that most of its members still refer to as communist. Further, who, or more likely what pressure groups, will determine the generally accepted economic rationale used in justification. Under the so-called Bretton Woods II system that ensures global financial stability today, whatever money the USA pays for Chinese imports is given back the same day as a loan. China is one of the chief financiers of America's trade and government deficits. That means China has a financial claim on the USA. Already, the Chinese are accumulating fewer dollars in foreign exchange reserves as a result of removing, under heavy political pressure, the renminbi's fixed peg to the dollar. What if China significantly reduced its dollar assets in retaliation to subjective tariffs on its exports? The result is the endgame scenario long warned of by central banks and policy wonks. Many analysts believe that if East Asian central banks stop financing the USA, there will be a sharp drop in the US dollar and bond markets, an increase in interest rates to 1970s levels or higher, and a fall in the prices of risky assets, particularly equities. So, a very serious risk factor to take into consideration. Call it Bretton Woods II or whatever you like, the current arrangement is carefully managed by American, European, and Asian central banks and global investors to direct shifts of capital across the globe. These shifts typically last for at least a generation, as one set of nation-states replaces another. In modern times, for example, we saw the USA replace the British Empire, just as the dollar replaced the pound sterling as the world's reserve currency. America is intimately connected to this process because as the most open economy in the world, it has been willing, so far, to restructure its labor market. Speaking plainly, the USA has been willing to lose factory jobs to China, as it did to Japan previously, because, so the theory goes, the American economy is replacing manufacturing with high-end services. The Chinese continue to finance the United States even though they may ultimately lose money in a currency appreciation because it is in China's long-term interest to promote an export economy that slowly but steadily absorbs its massive unemployed rural population and creates an urbanized and industrialized society. In my view, Congress's move signals abandonment by America of its willingness to accommodate the rise of China as it accommodated the rise of Europe and Japan before it. Seen in this light, what Congress calls a fundamental misalignment is actually America's growing integration with China. Chinese markets rebounded this week with the Shanghai Composite Index passing the 4,000 mark on June 12, and nearly all indicators are getting close to their in-May peaks. Rumors are circulating that the China Securities Regulatory Commission will suspend approvals for overseas listings. I have obtained no confirmation. Word is that IPOs valued at over $1 billion would go through, but reports say only on the Hong Kong Exchange or the US and Singapore. Meanwhile, the New York Stock Exchange and London Stock Exchange and NASDAQ all report record numbers of Chinese firms listing. London anticipates 100 Chinese companies may list by the end of the year. And so far this year, Tokyo, Korea, and Germany have each had a Chinese IPO. In a related move, Hong Kong red chips, the big mainland-controlled H-share firms, will be allowed to list on domestic markets. Lining up for possible issues are China Mobile, Lenovo, and China Offshore Oil Corporation. Chongqing Lifan Holdings, a major motorcycle exporter, will bypass Hong Kong for a Shanghai IPO to sell 25% to expand its auto production. Lifan began making the 520, a compact hatchback, only a year ago and has already sold 50,000. Setting the stage for future consolidation in the auto sector, First Automobile Works is still awaiting for approval of its domestic IPO, and Guangzhou Auto Industry Group, which I reported on earlier, is also hoping to list. A new one in the hot semiconductor industry, Spreadtrum Communications Inc., a maker of wireless chipsets out of Shanghai, will list on NASDAQ under symbol SPRD to sell American depository shares valued between $11 and $13 per share. And as I reported previously, China Construction Bank is moving forward with its plan to list on the Shanghai Exchange. The bank is listed as a H share in Hong Kong, and the Shanghai sale must be approved by shareholders this summer and approved by Chinese regulators. The sale could raise over $5 billion US. I'll see you next time.